Hey, Larry Berman here, and here's what's on my radar this week. Been thinking a lot of big picture stuff in recent weeks, and I'm thinking about this incredible rally that the markets have had in the last few years, coming off the COVID lows. So we're into the third year now of COVID, and it would seem for the most part that we're getting past that, with the exception of maybe what's happening in China these days. But these new variants keep coming up and less virulent. So all that is good, and I think we're moving past that. But the key thing with this rally is the stimulus that governments had put in. And that's really important when we come to think about it. So let's look at this chart. So normally when we talk about a correction, there's this idea of retracement. So we have this massive rally that came off the levels that we saw at the depths of COVID. S&P, at the low, somewhere around 2,200, and recent highs a little over 4,800. You could see there. So where does the correction go to? Historically, one of the things we consider is Fibonacci, the retracement. So that gets us back into the 35 to 3,800 on a normal course, moderate correction. When we look at the trend that's developed year to date, we look at these series of failed highs here, lower lows. This trend channel plays out. You project that towards the end of the year. U.S. election in here. We should dip below 4,000. Maybe we go as low as 3,500. 3,800 seems to me like almost a no-brainer at this point in terms of a test. It could come relatively soon. If you look at the bottom of this trend channel and where that projects to, and really over the next 2 months or a month or so, if we come down hard here, or it takes a little bit longer to get towards the lower levels, because certainly we would bounce again at some point here and kind of roll over. There isn't enough of a catalyst at this point to send the market a whole lot lower. We just don't know enough yet. So as we get it through earnings period here, it's going to be pretty important. But let's blow this chart up here and actually look at year to date. We've got 38 of the trading days so far year to date where we see, an open up here and a close down here, these blue bars, these colored in bars, versus the days like over recent couple of weeks where you open down and close strong, open down, close strong, and you get this strong rally. Well, in the last 2 weeks here, and this week in particular, every single day, with the exception of Wednesday, where market opens up, closes down. Market opens up, closes down. Well, here's a day market opened down, closed strong up. Looks like it's a reversal. Next day completely wipes it out. So the market's having trouble holding this bid. Yes, we came off the lows. It didn't look like, the war in Ukraine was going to be a problem, and we're getting by COVID, and the Fed might do less. And now we get all this talk about how hawkish things are and the Fed's going to have to do more. I think at a minimum, folks, we got to revisit these lows before the market can rally again. But I think we're going to cut through them. I showed you where those downside targets are. That's what's on my radar this week. A little bit of caution here. For those of you with cash looking for buying opportunities, I think you got to wait until we test these lows out and see what happens. Have a great week, everybody. Have a happy Easter, happy Passover, whatever you're celebrating. Make it a good one. There's no bull and bear pick of the week today. It's the bunny rabbit pick. So what do you pick for a bear, bunny, bull? I don't know. Anyways, have a good one, folks.